The whole, and so we could start with the fourth session of this conference, which is on the topic of assessing the impact and the effectiveness of residential real estate taxes in addressing risks to financial stability. And I would like to invite the moderator of this session, Henrik Braconier, who is a chief economist at Swedish Finansinspektionen, to present his panel.
Thank you, Christina. Okay, welcome here to session 4. Now we'll move in, I would say, a bit more into the details of how property taxes affect house prices, but also how house prices in turn will affect financial stability risks. And to discuss that, we have two distinguished panelists. First, Tigran Poghosyan, who is a senior economist at the European Department of the IMF. He's also the IMF resident representative in the Kyrgyz Republic, and he has worked extensively on issues of banking, asset prices, and fiscal issues. So he clearly has a relevant background for this discussion. Secondly, in our panel, we have Nico Valckx, who is also a senior economist in the IMF. He's team leader of the well-known Global Financial Stability Report and has worked on issues related to household debt and housing. So I would first like to invite Tigran to start presenting.
Thank you very much. I would like to thank the organizers for inviting me to this very interesting seminar. And today I would like to talk about property taxes and house price volatility. This is the subject I was working on when I was still in the Fiscal Affairs Department at the IMF. And before I start, the usual disclaimer applies. These are my own views. They do not reflect the official position of the IMF. So in terms of motivation, most of the things which are on this slide have been already mentioned. So let me just repeat once again that house price volatility, and I would like to highlight the word volatility here because we're talking about not the levels of house prices, but their volatility, are important for enhancing macro-financial stability, or are important factors that can affect macro-financial stability. And the main policy instruments that are used to smooth house price fluctuations are monetary policy instruments and macroprudential instruments. Both instruments have their drawbacks, which was also discussed. Monetary policy instruments are too broad-based and are not sufficiently surgical to affect different sectors. Moreover, we are not available for countries in the euro area because monetary policies are set at the central level. Macroprudential instruments, on the other hand, have also drawbacks that they affect market behavior, and there is evasion from them and leakages. The question is where fiscal policy can also affect house price volatility. We discussed mortgage interest deductibility, transaction taxes, recurrent property taxes during discussions yesterday and today. Today, I will focus on one particular type of property taxes, recurrent property taxes. In the US, these are the taxes which are set at the local level. And the question I will be asking is whether they affect house prices and their volatility, and whether this relationship is causal. This is also important, something which adds to the discussion that we had so far. Let me start by briefly reviewing the literature. So on the theoretical side, there is a paper by Van den Noort, which is a very simple model which illustrates how recursive or recurrent property taxes can affect house price fluctuations. And I'll illustrate it because it's very simple. I think everyone can understand it very quickly. And then on the empirics, there are not so many studies, and the main reason is it's very difficult to find data at the regional level on property tax rates. My motivation to start this work was actually the paper by Crow and others in 2013, and Dennis Tigran, who is present here, is one of the co-authors of this paper, where we use data, a cross-section of property tax rates in US to analyze the relationship between property tax rates and house price volatility. They find statistically significant correlation, but they don't explore whether this relationship is causal. Second, the OECD papers, which were also mentioned yesterday, Andrews and OECD 2011, they find that generous subsidies for mortgage debt increase house price volatility. However, the third paper by Arbitrage and others from Switzerland does not find a strong relationship, and as we heard also yesterday, sometimes the relationship is the opposite. Lastly, I wanted to mention papers on house price supply. Apparently, regulation and supply rigidities also affect house price volatility, so those should also be taken into account in the empirical analysis. Let me now briefly describe the theoretical framework. There are just three equations. The first one is an arbitrage condition, which says basically there should be no difference for individuals between renting a house and paying a rent on the left-hand side, R, and owning a house, in which case we need to pay interest, which is I, minus marginal income tax rate if there is mortgage interest deductibility. Then we need to pay a property tax rate, tau. There is a depreciation, which is also affecting the cost. And finally, there is expected appreciation of house prices, which, excluding capital gains tax, affects this part of the equation with a negative sign. Now, this relationship can be used to assess the demand curve, which is a downward sloping demand curve. And taxes affect the slope of this downward sloping demand curve. And we will, I will show you how it affects the slope shortly. The second equation is the supply equation, which says that supply today is a function of supply yesterday minus depreciation. And there is an elasticity of supply with respect to ratio of prices to costs. This elasticity is usually small, meaning the supply curve is, in the short term, is more or less vertical. In the long term, it can be upward sloping. And again, I will illustrate how it looks like in a moment. The last equation is showing the relationship, how prices evolve in response to demand shock. The main point here to note is that tau in this equation here is in the denominator. So the higher the tau, the lower is the denominator. So the demand shock, which can be seen as a shock to R, propagates with a greater amplitude when tau is lower or property taxes are lower, meaning there is more volatility for lower property taxes. Now let's look let's illustrate it graphically so it's clear. So here we have supply curve in the short run, which is vertical, and in the long run, which is upward sloping. And then we have a demand curve, which is downward sloping. We have two situations for low property tax rates and high property tax rates. For low property tax rates, the slope of the demand curve is steeper. And now let's consider equal demand shock in both cases. So from initial equilibrium A, in the short run, prices go up to B, and then in the long run, return to C. So this is the situation with low property tax rates. In case of higher property tax rates, the increase and the decline are smaller. So the main idea here is that the volatility in response to a shock, this jump here and reduction here, is larger when property tax rates are lower. Another way to look at it is to look at the propagation of demand shocks, and that's what's illustrated in this chart. It's again a simulation assuming 3 different property tax rates, 1%, 2%, and 3%. As you can see, in response to a demand shock, house prices are more volatile when property tax rates are lower, and the same applies to house price changes. So this is basically theoretically how to illustrate, why lower property tax rates can lead to higher house price volatility in response to demand shocks. Now let's see whether data supports this theoretical prediction. So I'm using data from US regions, 51 states and 77 metropolitan statistical areas for the period 2005 to 2014. House prices are taken from the Federal Housing Finance Agency. The volatility is defined using 2 measures. One is volatility of house price growth rates. Another is volatility of deviations of house prices from HP filtered trends. And volatility is measured using 5-year moving standard deviations. The second source is American Community Survey, which reports information on annual tax property payments made by households and the property values. So using these 2 informations, I take the ratio of the 2, similar to Crow and others, and I assess the effective tax rate at the regional level. I'm also using data on macro variables from the Bureau of Economic Analysis, the standard variables used in these kind of regressions, and I'm also using information on housing supply restriction indices. A few words about that. On geographical supply restriction indices, the idea here is to use satellite images to find out how restrictive it is to develop land in the region. So for example, if a city is located closer to a sea, it means it's difficult kind of to expand in the sea. So there is more restrictive supply in that city. On the regulatory side, it's measured based on information on housing permits and zoning restrictions. Let me now briefly overview the statistics. So this slide shows developments in house price growth rates and property tax rates. So house price growth rates were positive. This is the median. These are the 25th to 75th percentiles and minimums and maximums. In 2005, the growth rates were positive. Then they started, on average, going down, and then recovered in 2014. Property tax rates, the median was slightly less than 1%, and then it increased after the crisis, in part because local governments needed to replenish their revenue, so they increased the tax rates. What about house price volatility? As I mentioned, I'm using 2 measures, and 2 measures report similar picture. The volatility was lower in 2005, then it increased in 2009, and then went down again in 2014. There is large variation across regions, and it applies equally to the other measure of volatility. Before running any regressions, just a simple scatter plot kind of illustration on the relationship between property tax rates and house price volatilities using 2 different measures. As you can see, there is a negative association, and there is a lot of variation across this negative association, which means there are other factors that also need to be taken into account when analyzing the relationship. Now let's turn to regressions. So in the regressions, on the left-hand side, I'm using the measure of volatility, and I'm regressing it on property tax rates, and the main coefficient of interest is beta to see if there is a negative association. And there is also control variables here, and tax time and state-specific fixed effects. Please note that I'm not only looking at association and correlation, but I'm also trying to identify causal effects using 2 approaches, instrumental variable regressions and GMM. These are the estimation results using the first measure of volatility of house price growth rate. So the first two columns report results from the fixed effect OLS. So these are the simple correlations with time fixed effect, without time fixed effects and with time fixed effects. The main coefficient of interest is property tax rate. As expected, is negative and significant. And here is reported the economic significance, meaning the response of volatility to one standard deviation increase in property tax rates, which is about 0.5. So as you can see, the economic significance says a one standard deviation increase in property tax rates reduces volatility, in terms of correlation, reduces the volatility between 1.5% to 1.3 to 1.5%. Now, this is simple correlation, and the causality may run the other way around. In other words, it could be the case that regions which have more volatile, inherently more volatile housing markets are the ones who increase, property tax rates, and if that's the case, that would, bias the coefficients upward. To check for that, I also run instrumental variable regressions, where in the first stage I instrument property tax rate by in region by average property tax rates in neighboring regions, and it's a standard approach used in this regional literature. The idea there is that when setting property tax rates at the regional level, usually local authorities take into account what's happening in their neighboring regions. So doing that, increases in absolute value the coefficient estimate by almost twice, and that basically confirms the upward bias of the coefficient in this case, and in case of OLS, and the economic significance increases, from 2.3 to 5.5. The last exercise I'm doing is, running the same thing using GMM, and here again, same results, negative significant coefficients. This line shows the same analysis, but using different measure of volatility of house prices, using the trended house prices, and the results are more or less similar. Now, the second type of exercise I'm doing is to run Rajan and Zingale style difference in difference regressions. Now the analysis is done at the MSA level, Metropolitan Statistical Analysis level, where the main idea is the following. So some metropolitan statistical areas have more rigid supply of housing than others. And one could expect that increase in property tax rates on average at the state level would affect more MSAs with more rigid supply than the other MSAs with less rigid supply. If that's the case, when this interaction term, the coefficient of this interaction term, lambda, would be negative. And that would, provide support to the idea that the causality goes from property tax rates to volatility and not vice versa. Before showing the results, let me just show the relationship between supply restrictions index and the regulatory restriction index. As you can see, there is some association, but it's not exact, which means these two restrictions could be considered as separate restrictions when analyzing difference in difference regressions. And here are the main results. So the main coefficient of interest is this interaction term between property tax rate and supply restriction index. And irrespective of whether we use geographical measure or regulatory measure of supply restrictions, and for two different measures of house price volatility, we still get negative and significant coefficient estimates, which support the idea that there is a causality running from property tax rates to house price volatility. In other words, when property tax rates go up, it's regions with more rigid supply that are affected more compared to regions with less rigid supply. To conclude, this analysis you can think of it more like as a positive analysis. The idea was to assess whether property tax rates have a negative impact on house price volatility. Empirical estimates suggest that yes, there is a negative impact, and it's not only correlation, but it's also causal. 0.5% increase in average effective tax rate reduces house price volatility, depending on the estimates between 0.5 and 5.5. The policy implication is, that property taxation affects house price volatility, so higher property taxes reduce house price volatility. In principle, it could be used as a tool. We can discuss later, whether it should be used or not. But there are also some caveats that this analysis is based on US, and more probably analysis is needed also in other countries just to see, how this works in other countries. And the sample period includes the global financial crisis, so that could, affect somehow the results. Last thing I wanted to show you, is how to think about it, like in terms of the illustration graphically. So the blue line here shows, the house price volatility for the original sample, meaning what we have in the data. So the mean is 0.93%, and standard deviation is 7.6. And the analysis presented suggests that if property tax rates were one standard deviation higher than we are in reality, then the standard deviation of house price growth rates would have been 4.6, and the picture would look, volatility of house prices would be looking like the red line. That's it from me. Thank you for your attention.
Good morning, ladies and gentlemen. Welcome and thanks for the invitation to the Central Bank of Lithuania. My name is Nico Valckx. I will be presenting an analysis that we did in the Global Financial Stability Report of last April, April 2019, which pertained to a specific part of house prices where we are interested in house price downside risks and the implications that has for financial stability, and whether there is any type of policies that can help to mitigate downside risk to house prices. We didn't particularly investigate the role of fiscal policy. Casually, we mentioned it, that we did not find much, but since Thomas invited me to the conference, we kindly obliged and did some additional work, as you will see in my presentation. This actually, to further frame it, is part of a broader analysis that we do in the Global Financial Stability Report over subsequent editions, where we have looked at housing and household debt in recent years. We started in April 2017 by looking at the effects of changes in household debt on macro-financial stability. In April 2018, we devoted a specific analysis to the synchronization of house prices across different countries. And as said, this analysis looks at the downside risk to house prices. So to start off is the question, can we really measure or estimate what is the downside risk to house prices? And quoting from one notable expert on the subject matter, Robert Shiller, in a New York Times interview, he said, well, the increase in house prices can't go on forever. That's as much as everybody seems to agree. But when it will end isn't knowable. The data can't tell us when the prices will level off or whether they will plunge catastrophically. Well, actually, that's the question that we will try to answer with our analysis. And as a prelude, indeed, we do seem to be able to answer that question through a technique which uses quantile regression. So it's a bit technical. I will spare you much of the details. But basically what that does is it tries to estimate the distribution of house prices, much as Tigran showed in his last slide, over time. As you can see in this picture, this could be the distribution of house prices over time. When there are bigger downside risks, the left tail would become bigger relative to the median, what you see in the yellow part in the middle. And in period of booms, you would see an expansion in the upside, the right tail of the distribution. This is a technique that we borrowed from one of our other popular analysis, growth at risk, basically. Now, what we try to measure with house price at risk is how far, in real terms, house prices would decline at a given probability. We take that a low probability, the downside, measure that 5% of the tail of the distribution at or for a given horizon. Then in our analysis, we looked what does that imply for growth and financial stability, and what's the possible impact of various policies on that measure of downside risk. So this is my outline. I will very briefly talk about some global trends. We've seen already a couple of times some global trends about the housing market, so this will be very brief, and why we care about house price risks. Before going into some specifics, but not too much on how we measure the downside risk, to give you a gist of the technique and the feel for the data. Briefly, I will mention some financial stability implications, but mainly I will focus on what policy can do to mitigate downside risk, because we think it's important. Something to just illustrate that house price growth has been buoyant in many countries, both advanced and emerging markets over the past 5 years. And that has led to warnings about overheating by many central banks, including the ECB, I believe. Another aspect that I mentioned before, we saw that there is increased synchronization of house price increases across countries. This is a very simple measure. The share of countries that had seen a positive growth in real house prices, that has increased in the past 5-6 years or so. We have more complicated measures as well, but this is very simple. To just demonstrate that house prices have become also more of a financial asset with a real return. However, at the same time, if we look over longer periods of time, we also see that it's not uncommon that there are huge declines and busts, basically, in the housing market. This is not uncommon, so there is definitely an element of downside. It's not a guaranteed positive investment. And that's a lesson that was painfully learned also in the 2008 global financial crisis. So why we care about house price risks? It has both a conceptual and a practical aspect to it. The practical aspect has already been mentioned many times, because it's a very large asset of many households, but also a liability asset, in a sense that for households is the biggest investment that they can make. On average, the share of housing wealth in total household assets is about 60% of the total. And also loans represent for housing an important substantial share of their total borrowing behavior, about 60-70%, most recent data from the OECD. And obviously, it's an important category of lending for banks, and that means it has definite financial stability implications if there are defaults in the banking sector pertaining to the housing market. That can be huge, especially when there is a large share of borrowing going to the mortgage market. Now, also in theory, we developed a model that shows that in good times, when the economy is doing well, growth is high, financial conditions are easy, there are positive spillover effects to housing in a sense that households increase their leverage to buy another house, a bigger house, and prices increase. But when the economy gets affected by a negative shock, and when household debt is at a high level, it means that further borrowing becomes more difficult, and households face a constraint on their lending, a collateral constraint. And as their income declines, it means that the collateral constraints becomes more binding. This may give rise to forced selling, which has, again, further negative effects on the house prices and makes the household constraints even more binding. And that will have then negative repercussions for consumption, aggregate demand, and in general lead to a tighter financial conditions. So there's important feedback effects taking place, and this analysis also illustrates the main factors that we will analyze in our discussion later on pertaining to house price risk, namely the level of household debt, the financial conditions, the general state of the economy, and a measure of valuation of housing, or if you want, affordability of housing. Now, in this model, as I mentioned, it's also possible to show that actually when household debt increases, the probability of a crisis becomes more pronounced, which you can see in this red line, which is much more negative than the relation between household debt and house prices at the median or in the upper tail of the distribution. And this is what we want to exploit with our technique, the quantile regression, is basically finding this relation in the tail of the distribution, where the sensitivities are higher and the responses are bigger. So very briefly, how do we do the quantification? With those 4 factors that we identified in our theoretical model, we see that the association is generally more negative, in the tail between financial conditions and house price risk. For credit to GDP and house price growth is slightly more negative than in the median or in the upside. And also definitely with a measure of valuation in the housing market, the price to income ratio or an equivalent measure that measures a deviation basically from a fundamental value. Only with the state of the economy, we do not really see much of a different relation in the tail versus on average with respect to future house price growth. And this is obvious when we do this panel quantile regression technique, where we pool observations on the real house price growth from different countries. Here we distinguish between advanced economies on the left and emerging market economies on the right. We do find that there are significant responses to the various factors that we identified based on our theoretical model. There is a negative association with the measure of overvaluation. So the more overvaluation, the more likely there will be a downside risk in the future. And this estimation is done over different horizons of downside risk from 1 quarter to 16 quarters ahead, basically. We also find a significant impact of credit when there is a credit boom that will lead to downside risks in the future. So more negative realization in house prices. And financial conditions also play a role in the sense that the tightening of financial condition will have negative effects on future real house prices downside. So how does this measure look like for one particular country? Just to give you an example, on the left you see how our measure of downside risk evolved for the United States with a 3-year ahead window in mind. So it estimates the probability of with a 5% confidence or a 5% risk, what would be the realization or the most negative outcome for house prices in the US. And you see that initially in the early 1990s, there was a risk of high declines in house prices, but then markets eased up until turn of the century, but then gradually there was a start of a increase in the downside risk. There's not a realized house price growth, but what is implied at the most negative, worst possible outcome in a way. And you see that before 2008 financial crisis, the measure really hit a very low of almost minus 10%. Yeah. Then it recovered, but now again you see a declining trend. More negative house prices in the tail are likely, so the main risks remain elevated at the medium-term horizon. So when we look across our sample of countries with our measure and take a 10% threshold as a sort of cutoff rate, how do we see the evolution of risk? You see that most risks are now concentrated in Asia Pacific, China, Malaysia, Hong Kong, and other countries. I will speed up a little bit, but just to say that also over time, when you look at house price risks, there has been shifts between what we saw in 2007 before the start of the financial crisis and more recently, that countries that were highly at risk then seem to have shifted out, and countries that were less at risk seem to have become more risky. So they shifted from one quadrant to another quadrant. And these figures here are weighted by GDP. The green dots are emerging markets and the blue dots are advanced economies. And obviously you can imagine this as the United States, and this would be the biggest emerging market in our country. That would be China. So this is so far an in-sample analysis. You can explain a lot, probably, historically, yes, but also, does it also work out of sample? And we've illustrated that more in our report, that indeed it does have important out-of-sample properties or predictive power. Now, I'll briefly go into a financial stability angle or motivation. Just to illustrate that when you have a financial crisis model, a typical financial crisis model that includes the economic cycle, financial conditions, and credit gap, which is typically used by BIS. And when we augment that with our measure of downside risk to house prices, going from the green to the red, seems to importantly increase the R-squared or the explanatory power of those types of models. So it's an additional factor we believe that is important to add in the modeling. Now, you might wonder, is there anything that we can do once we see this type of measures in terms of policies? So that's the question that the conference tries to answer, whether macroprudential policies or fiscal policies may play a role. And I think even yesterday, one of the panelists asked specifically, does it help to reduce downside risk? Tigran already made a case for fiscal policy in his case for the US. This is a more general model where we examine macroprudential and monetary policy specifically. And we try various cases. One case is where we model macroprudential measures through an imposition of an Poghosyan tax on the borrower constraint, the T rate here. So it makes the borrowing conditional on the state of the economy and introduces a tax in order to reduce basically your loan-to-value ratio. You can also think of another mechanism that could affect house price downside risk through monetary policy by augmenting the reaction function of the central bank, by making it respond to household debt, or by responding to credit spreads. So when credit spreads are high, for example, you can imagine the central bank would lower interest rates to accommodate the negative effects on the economy. Or when household debt levels are very high, nominal interest rate would increase in order to reduce that sensitivity. So what we find in this context is that macroprudential policies are more effective than monetary policies. And the difference with respect to housing is very significant. If you see the MP1, MP2 are various effects on house price risk. You see a much more negative effect in a downside scenario when GDP will be in a will get to a recession. When you use macroprudential policies, you're able to contain the effect on the house prices. But at the same time, there will be bigger changes in the credit to GDP ratio when you use macroprudential policies, and also if you use a policy rule that focuses on household debt. So that's for the theory, but also in practice, we do see that when you tighten on your left chart financial condition, macroprudential measures, you get a positive effect on the downside risk, so you reduce downside risk. Basically, you shift the distribution more towards the center, so it means that macroprudential policy is able to contain the buildup of risks or increase resilience. Whereas monetary policy, you see the effect is very significant, but only at a very short term, 1 or 2 quarters ahead. For the rest, the effect is neutral, which was in line with our prediction from the model. Now, there are other possible policies that we could think of. One was, or one that we had looked at in our GFSR, was capital flows. The story being that in countries such as Canada, Australia, the UK, you have seen a lot of discussion about foreign buyers and the effect that they have on local housing prices. And what we found from this analysis in the left chart, this green line looks at the upside risk to house prices, that indeed foreign buyers do have an upside risk, or increase the upside risk to house prices. But they also have an effect in the sort of medium term between 4 and 8 to 10 quarters ahead, that they will potentially increase the downside risk, and probably there is some form of channel that works through increasing the prices and overvaluation at first, which then leads to some form of a correction over time. Can policymakers do something about that through specific capital flow measures? Our findings are not so convincing. Maybe in the medium term there is a effect, but it's very limited. So we would argue in line what we've argued on capital flows to make it very limited, precise, and when there is no alternative. Now the question on fiscal. It's something that we didn't include in our study, so this is new. First of all, this is based on 2 sources. One is specific cases of tax reforms that were taken from a study from colleagues in the Fiscal Affairs Department, where they looked at the composition of major tax reform by tax type. And here in the bottom you see property tax related reforms. In the overall scheme, they are a very minor component of all tax reforms. So what we can gain from that is probably very limited, and that's also what we found in our analysis. I mean, maybe a better approach to look at this particular component, and I'll show you some charts, is through case studies, wherever those reforms were introduced to the tax rate or the tax base for property value assessments, or through changes in the mortgage deductibility. Maybe if you look specifically at cases, we can gain something from that analysis. But with our setup, with the panel data analysis, there's too few observations basically to find something. However, we do find something when we look at tax-related macroprudential measures. What's that? So that's any fiscal measures that are aimed at containing risk in housing markets or in the household sector. These relate to stamp duties, capital gains taxes, reduced interest deductibility, but specifically with a focus on containing risk in the housing market. So these are the cases of Hong Kong, Korea, Singapore, UK, Canada, Australia. And when we look at that, this chart on the bottom right, we do see that initially they have some sort of non-significant effect, but over time, medium to long term, they seem to reduce the downside risk in the housing prices. Another impact that they have is that they seem to reduce the synchronicity of house prices across countries. So there is some value from tax measures, at least based on this analysis. I'll also briefly mention some cases. Canada, they did 2 reforms to reduce interest deductibility, the effect of which, this is a complicated chart, so let me explain. The blue line is the measure of downside risk. The red line is the measure of upside risk, so the 5% highest estimated increase over a given horizon, over a 1-year horizon. And in the middle is sort of the realized house price and the median house price that we estimated from our model. So, but since we are interested in the downside, we see that those 2 measures, making it tighter, lower the deductibility, seem to have led to increases in or reduction in the downside risk. Yeah. In the UK, we find similar evidence of policies going in the same direction. But maybe the most interesting cases, as we learned yesterday and today, from Sweden and the Netherlands, so this is tailored based on what I learned yesterday, is when Sweden announced a policy to lower property taxes in, what was it, 2006, and then introduced it, started in 2008, you saw that that actually led to an increase in the downside risk. Whether it's causal, that's another question, but this is sort of the association that you can see in the data. Similarly, for the Netherlands, which we learned this morning, they reduced, starting in 2013, the mortgage interest deductibility and some other measures. What you see since then is that the blue line, the downside risk, really improved. So much lower downside risk. It also had effects across the distribution. Also the upsides improved. Yeah. So this is just tentative, but at least it gives you some idea of where this might go. Some other countries, Germany and France, you see they did a lot actually of reforms, and it's actually a bit of a mess. It's too much data in there to really make sense of it. Sorry, I should tell this is not the IMF's official view, but my own in terms of these findings. Conclusions and policy implications. So we have illustrated this measure of downside risk. We're able to document nicely how it evolves over time and across countries. And it seems that certain types of policies may have an effect more than others. Macroprudential seem to work more than monetary, and there's evidence of fiscal effects also playing a role to this effect. But as usual, more work is needed. Thank you. Please.
Okay. So thank you for 2 very interesting and I think very clear presentations. I would also say that I probably see them more as complements than substitutes, but I leave that to John to finally decide. Tigran, you make the connection between property taxes and house price volatility, whereas Nico focuses more on the risk factors to house price risks and how that feeds into financial stability risks. So I would like to start with a question for you, Tigran. You talk a bit about the economic relevance of your estimates. So could you perhaps elaborate a bit on that? I mean, how if we were to move from a sort of very low tax rate, property tax rate, to very high, how much would we gain in terms of lower volatility?
Yes, so the standard deviation for the sample as a whole of house price volatility is around between 5 to 6%. And the results suggest, if you take, let's say, the result for the instrumental variable approach, 1 standard deviation increase in property tax rate. So the median property tax rate is slightly less than 1%, and one standard deviation is 0.5. So increase, let's say, from 1% to 1.5% would reduce the volatility by about between slightly less than 3%, so by about half of total volatility. So it's quite a significant decline.
Okay. And one of the things you mentioned in your presentation here is that, I mean, it's of course always difficult to extrapolate from, in this case, US data to international data. But I think, thinking about it, at least comparing to other countries, I would imagine that on one hand you have sort of typically a higher supply elasticity in the US. So you would that would in some sense affect your results. And on the other hand, you would probably, if you take a European country, would probably have less of a sort of tax-based evasion effect than what you see between US regions or US states. So how do you think that would play out if I were to push you in terms of effectiveness?
So when it comes to supply restrictions, we need to probably distinguish between exogenous supply restrictions and policy-driven supply restrictions. So true that maybe in the US, on the policy side, the supply restrictions are not as big, let's say, as in other countries. But exogenous restrictions, such as, let's say, geography, this is something, not driven by policy. It's simply, the city or metropolitan statistical area is located close to a sea, let's say. It's just difficult kind of to expand, supply on the seaside. And this is something, completely exogenous. This is something which is difficult to address through policies. So one needs to kind of differentiate. In Europe, housing permits, zoning regulations, and so on, typically play a larger role. And this is something, which has to do with preserving historical heritage of the city, for example, basically other areas which are maybe not so much economic, but based on culture, and one should also take those kind of constraints into account.
Okay, thank you. Nico, so now thinking about the different policy instruments, you mostly have been looking at macroprudential versus monetary policy. But of course, one of the themes here is fiscal as well. So how would you think about the sort of interplay between these instruments? One way of reading one of your charts, which shows the figure of in some sense, what is real estate taxes in the sort of big tax reform picture, is that the Venn diagram is very small, in the sense that the overlapping intersection is really small. So what would this actually mean for the policy interactions that we should expect to see, and how they would play out?
Yeah, okay. I think it's important to realize in a bigger picture, holistically, that taxation of property, and that's also what came out from previous speakers, represents a small share of the revenue of the government in the first place. So that's important to keep that in mind. But at the same time, I think it's important to avoid wrong incentives or wrong types of behavior from taking root through increasing incentives to take on more debt, or leading to more vulnerabilities related to housing prices and so on. So there are important potential effects taking place, and that's what you saw from some of our analysis when Macropru is used as a systemic risk, when fiscal policy is used with regard to housing as a systemic risk tool through Macropru. For example, by imposing taxes on foreign buyers in a couple of countries, you do find indeed that it can have significant effects to reduce house price growth. There was one study we did in 2018 for Hong Kong specifically, and that showed that through fiscal measures, increasing stamp duties and taxes on empty buildings, authorities were able to lower the rate of increase of house prices and to contain the level of household debt significantly from one year to the next. Of course, it's a counterfactual analysis. You don't know what would happen if they didn't, but at least that's sort of consistent with our intuition. So it's, as I showed, a very small part of the overall government revenues, but nevertheless an important one specifically for this segment where there is an intersection of different policies. As I showed, this influx of foreign capital, there is potential macro risks through household debt, importantly taking risk, and the price behavior in itself can have destabilizing effects. So it's important to holistically think of the various policies and policy goals for that matter. And yeah, I would agree with John's analysis and others that it's important to clearly define what's the objectives that you have and what are the best instruments to achieve those, and also play or effectively have coordination mechanisms in place between the different authorities.
So in some sense, I mean, one way of reading what you're saying is that fiscal policies can be quite effective, but they are very seldom used in this perspective.
Yes.
So I guess that in some sense could come back to the sort of political economy issues that we've been discussing over the 2 days.
Yeah, I think it's like once in a lifetime you can do I think somebody said it yesterday, once in a lifetime you can do a tax policy reform. And that's basically what our data showed, that it doesn't happen that often. And it can have major consequences for the next generation.
So you're basically suggesting that, I mean, you
do it right.
You do it right because you have one attempt, and then that sort of will be a one-off effect on financial stability. And then we hope it. Tigran, do you agree on that?
I just wanted to add that, you know, when it comes to fiscal policy, and as was mentioned during today's keynote speech by Governor Klaus-Knot, sometimes fiscal policies have different objectives, completely different, I mean, not related to financial stability, but in pursuing those objectives, they have side effects for financial stability. So, macroprudential regulation sometimes offsets something that, a distortion which was created artificially by fiscal policy, not intentionally, because I mean they have completely different objectives, but then macroprudential should step in with another distortionary measure to revert back something which was distorted in the first place by fiscal policy. So when you have this kind of situation, when one policy instrument has side effects or spillovers on other objectives, coordination is important. And I'm not saying that fiscal policy should be actively used, and it cannot probably be actively used to address financial stability because of implementation, like even, I mean, or legislation, like it's a completely different setup there. But in terms of automatic stabilizers, for example, or in terms of coordination with other policies, there is scope for improvement.
Okay. So let's open up to the floor if there are any questions to the panelists. Okay, over here.
My name is Piotr Wdowiński, Narodowy Bank Polski. I have a question to Tigran. Do you have any outliers in your sample? Do you think you could run a regression by omitting one object at a time? How did you deal with outliers? Thank you.
As was shown in one of the scatter plots, there is quite a lot of variation across states, so I'm sure there are some outliers. I didn't, test for their significance. But in the regressions, I used robust standard errors, and it's one way of mitigating the impact of heterogeneity of observations and possible autocorrelation. So that's the way how I addressed it, but I didn't do specific tests for outliers.
My question is also to Tigran. If I'm not mistaken, from reading the papers by Braconier, I had the impression that in the US, property taxes are deductible from income taxes, at least to some extent. So I wonder how this fits with your simple model, because in your simple model there was no tax deductibility from income taxes, and from the empirics, I wonder if your results for the US should then be considered as an upper bound for European results, because in most European countries, property taxation is not deductible from income taxes.
So in the theoretical model, you can drop some of those taxes, and the result on the slope will not change. I mean, you can think of a European case, let's say, where there is different setting in terms of deductibility. The most important thing is there just to recognize that recurrent property taxes affect the slope of the demand curve, and because of this, a shock, positive shock, for example, negative shock to a demand curve, will result in more volatility when property tax rates are low. When it comes to empirical analysis, the beauty of the American community survey is that we report information on actual property taxes paid. So if there was a deduction, let's say, that would not be included. And then you divide that actual amount paid over the value of the housing to determine what the effective tax rate was after all the deductions were taken into account.
Mats?
Okay, thank you. Two questions. First for Nico. Regarding the measure, so I think it relies very much on the same framework as for growth at risk measure, and that framework is built on financial conditions index. Since here you're more interested in house prices, and I was wondering if you were, instead of financial conditions index, which applies to all economy, if you were to use something which is closer to the housing market, or maybe if it's suggestion, whether it makes sense from your point of view, or you would still prefer to use financial conditions index, or the way ECB is using systemic risk indicator, sort of, which includes a measure with better early warning properties in a way. One question, and a question actually to Henrik, whether you agree with the results which were provided with respect to Sweden on this house price at risk measure. Thank you.
Okay, Nico, do you want to start?
Yes, with regard to the financial conditions index, it's a kind of financial conditions index that we use. Obviously, what we take into account are the price of risk, so various interest rates, spreads between long-term and short-term interest rates, equity prices, equity volatility, exchange rate, that capture all kind of different fragments that have to do with the cost of borrowing, basically, pertaining to FX borrowing, pertaining to long-term borrowing, short-term borrowing, and the stance of monetary policy. So we take that as a better measure than just one specific indicator of financing costs, which may be sensible to do if you look at one particular country, where you know that this particular interest rate is the reference rate for that country, but that would not necessarily be the same in another country. So for our type of global analysis, where we look across countries, we found that our financial condition index, which measures the overall price of risk, is a better tool to use in this regard than those specific ones. But that doesn't mean for specific countries that we can tailor what we put in the financial conditions index, or just replace it with some measure of the borrowing costs for that particular country. And that's our advice when we want to implement this in specific cases. For example, nowadays we use this tool when we go to countries to do an FSAP, financial sector assessment, to look at a more tailor-made model where we include also additional factors that may be important in that particular country related to maybe the supply side and so on of the market. But yes, it's a good question. Yeah.
Okay. So, I mean, on a sort of superficial basis, these results that we see are sort of contradicting what I said yesterday. And I actually think, I mean, it's not only superficial. It is true. I mean, this is, of course, I mean, there are a number of reasons why these results could differ. But I think one way of starting to think about Tigran's results, for example, is that I think that the effects of the tax differences that you discuss on user costs are probably much higher than the effects on house price volatility. So in some sense, I think there is some resonance with what I showed yesterday. But that is sort of, I mean, back of the envelope guesses, more or less. The second thing is that it is, and I know that you've done a good work in terms of actually doing the econometrics here, because we have a number of identification problems in these kinds of studies. One of them is that if for some reason you get exogenous shocks to house prices, then if you have a balanced budget, then you typically could, that leaves room for government to lower their property tax. So you can get a sort of identification problem. Of course, econometric techniques should take care of that. To what extent they actually can, it's difficult to say. The other potential identification problem is that higher tax rates typically also can mean that you get better public services. I mean, that's one way of where US local governments sell higher property taxes. You'll get better schooling as a consequence. And of course, that could prop up house prices as well. But as I said, I mean, you've done the econometrics, you've done the IV estimates, GMM, so I think to what extent that fully takes care of these identification problems, I'm not the right person to respond to. Do you want to add something?
No, I agree that it's difficult. I mean, in terms of identification, one needs to do more work here and look for natural experiments, you know, to try to dig deeper, you know, what exactly the causal effect is.
Just then the question to Tigran. So it was a very clear sort of paper. You had a hypothesis, you test it, you get kind of very clear answer. If you were to do similar analysis on stamp duty, what would be your first hypothesis? Sort of what would you expect? What you sort of thinking? Maybe you're probably better familiar than we are with literature on this particular issue. What are at least the current status? What is in empirical literature? What they have found with respect to the stamp duty?
My reading of the literature is that stamp duties are more complicated than recurrent property taxes. The reason is because stamp duties are mostly used as discretionary instruments, in a sense that, like, for example, Hong Kong is one example. When we see, you know, there is no other way kind of to tame house price growth, we increase, let's say, stamp duties or try to, in a discretionary fashion, kind of follow those developments. That creates this issue of identification, because it's not clear whether it's stamp duty that affects then house prices, or we change the stamp duty because we saw that house prices were growing faster. My kind of suggestion is to mostly use fiscal policy as in the form of automatic stabilization, meaning in good times, when house prices are going up, fiscal policy should kind of, without any discretionary changes, reduce the overheating, and in bad times, the opposite, basically, prevent house prices from declining further. And also because, fiscal policy has changes in fiscal policy in a discretionary fashion are more difficult, require some sort of political consensus, require sometimes changes in legislation, and there are other differences. That stamp duties can be across the board, whereas recurrent property taxes are more regional at the regional level. Yeah, it's a different kind of instrument.
I mean, just to add, I would refer to our IMF study in the Article 4 for Hong Kong last year, where we looked at exactly the combined case of tightening loan-to-value ratios in Hong Kong and increasing the stamp duty, that both were effective. The stamp duty increase, for example, by 1% would lead to, or led to an reduced appreciation of house prices by minus 1.2%, and the LTV increase or decrease by 10 percentage points led to a decrease in house price appreciation by almost 5%. So both seem to have worked, and combined they led to a situation that if they had not done that, house prices would have increased by 12.5%. That's what the study said. So,
okay, I think time's up, and I think it's close to lunch. So please join me in thanking the panelists.
Thank you.
I would also like to thank the speakers and Henrik for a great session. And now it's lunch break, and we would like to invite everyone back at 2 o'clock sharp. Thank you.